All right, a look at some of the stock movers this morning. Jenny Horne is with us, host of Next Gen Investing. So he gave you a little preview. He didn't give all the details, but it sounds like Disney had some good news. Jenny.
Definitely, and I have to say that it's a welcomed sigh of relief for those that have followed, the tourism space, but also the streaming space. There's a lot of different reads you can get from Disney in the overall media world because it's such a massive company. So soaring after reporting earnings that did pretty heftily exceed targets, as well as unveiling a plan to build this new theme park now in Abu Dhabi. So they did report adjusted earnings that blew past expectations, $1.45 a share. Revenue rose 7% from last year to around $23.6 billion. Also did exceed forecasts for top line there. But revenue for their experiences segments, which does include those theme parks, rose 6% from a year ago to $8.9 billion. Also better than the street had been expecting. Also, this seemed to really reassure investors because, again, there's been such a concern that potential tariffs could weigh on tourism and overall the consumer's willingness to spend on vacations. So big ticket items is definitely what comes to mind when you think about Disney theme parks, because as anyone knows that has taken either their family or just themselves, it is not a cheap experience. But shortly after they posted those earnings, they did announce they'll be building that new park on Yas Island in Abu Dhabi. They did say it'll be their 7th park overall, as well as their first in the Middle East. And their chairman of the company's experiences division had nothing but hugely positive commentary to say, saying this is a groundbreaking resort destination and that their resort will be the most advanced and interactive destination in their portfolio, which I can only imagine because from what I've seen, everything that is in Abu Dhabi is pretty state-of-the-art, top of the line as far as technology is concerned. So they did not reveal a launch date for this park. They also did not unveil how big it will be to start with, but definitely enthusing investors. Aside from that, even their streaming division, which I know is one that the street pays a ton of attention to, which of course does include Disney Plus, but it added about 2.5 million subscribers, while its operating profit increased sizably to $336 million from just $47 million a year ago. And so they're expecting now adjusted earnings per share of around $5.75 for their current fiscal year. So although they did say they're still monitoring the developments they're seeing as far as the macro is concerned, this was actually well ahead of what the street had been expecting. So, this was as good of a report as you could see. And this stock needed a well-needed boost. We were down, at least through Tuesday's close, about 17% on the year, compared to about a 4.7% drop in the S&P 500. So we were well needing this optimism. And, across the board, firing on all cylinders from Disney today.
Yeah, and really nice picture here. As we talk about the turnaround plan, the comeback plan for Disney, which was the darling and then was selling off, and you had activist investors bringing back management, etc. So it's interesting, too, to see the subscriber growth being very much alive for the Disney Plus and people willing to pay up. As you noted, discretionary spending, right? You don't have to go there and you don't have to have Disney Plus, but people think it's important, and that's the key to the business being the winner, right? You're seeing that subscriber dedication to the brand coupled with the growth.
Well, right. And I think also now with such a great bundle deal, like you do feel like you're getting, if we're right now the cost conscious consumer that all of the discretionary companies seem to act like we are, which definitely when it comes to streaming, I am trying to cut down on my subscriptions. It does feel like you're getting a good deal when you bundle. Like I have the Hulu, Disney Plus, ESPN Plus bundle, I think, and whatever it's charging me a month, it's not enough for me to notice or to cancel it. So that is maybe perhaps their win. But Disney, I think, showing that it's not just Netflix dominating streaming, that they're still able to grow and there's still market share to be had that isn't just, again, being captivated by Netflix, which has been such a banner performer in the streaming space.
And I'm excited for all the folks in Abu Dhabi who had never been on a roller coaster or whatever exciting experience they have. Uber, let's talk about this story. Obviously, Uber, a great company that had that path to profitability, has seen the growth, has multiple revenue streams. Did have a revenue miss, though.
Did have a revenue miss, and I think I believe Kevin said this just moments ago, but I was in agreement where this name was also just in a very different position into this report. As you could see from from the recent trend, we've been in a considerable uptrend. We are actually, we closed yesterday at 85.83 a share. So highs in this name, 87. The fact that we were just 1.3% off of those highs is frankly really impressive. So perhaps expectations were just a bit too high here, as we did see some mixed first quarter results. They saw adjusted earnings per share that did actually top forecasts, and revenue that rose 14% from last year to $11.5 billion. That did, though, slightly miss the mark of around $11.6 billion. Gross bookings also increased about 14% to $42.8 billion in the quarter. That figure also did, though, come up slightly shy of around $43 billion that had been expected. And so trips, or the number of course, connected rides and delivery orders in the given period, still rose 18% to over 3 billion. Uber did attribute this change in part to the growth they've seen now in the monthly active users on their platform, and also did see adjusted EBITDA in terms of 1.86 billion. That was also slightly ahead of what they had previously given some expectations for. So, it was in the range of their prior expectations, but slightly at the high end if you want to take the most optimistic read. But they did also guide for gross bookings in the second quarter to fall between around 45.75 and 47.25 billion. Also seeing some weakness today, but again, this name has been really unstoppable. We actually saw DoorDash also see some pressure following their quarterly report yesterday. So I think maybe these names that have outperformed, we're just seeing some necessary pressure as we've been in such a considerable uptrend in Uber. We're up at least through Tuesday's close, of course, not including some of today's pressure, 41% on this year.
All right. And, I think about Uber, and they made that deal yesterday for food and grocery delivery in Turkey, $700 million for Trendle Go. Gross bookings that you noted up 14%, but that missed the expectations. But in the meantime, it really is the behemoth when it comes to ride hailing. Lyft is not Uber. A final thought?
It's not. It's really not. And I will say, even from personal experience, they're not. I feel like something has happened in the last 5 years where there's really been an escalation in quality and wait times in Uber, especially, where I do not even take really Lyft as much anymore because Uber is just so much better, in my own opinion.
I saw Dara on TV today, Khoshlawi, the CEO, right, who was talking about people's ratings, and he was saying 4.5 is really bad. So I'm checking mine, and I'm 4.83.
I think I'm 4.8. Okay. I'm not much above 4.5 though.
But he said 4.5 is really bad. I'm 4.5 is really bad. I wonder what I have. If maybe I complained about the air conditioning or the radio one too many times. I try not to say a word in there. My kids told me don't say anything when you go in the Uber.
Right.
Yeah. Okay.
Me too. I'm silent.
Jenny Horne, thank you. Nice to see you. Thanks for that look at Uber this morning.